Good morning. Thanks very much for joining us. Welcome to the RealX Auditorium. My name's Richard Betts, and for those who don't know me, I'm the publisher at Real Asset Media, and we run a series of these live events, maybe 60 or 70 a year, covering hot topics, different sectors. And this morning we're going to be looking at European residential and also taking a particular look at affordable housing, particularly the investment side, but also looking at some of the key trends, because residential has certainly outperformed during the pandemic. And so we're really looking at that and also the outlook, particularly for the affordable housing side. So I've got a super panel here. Let's just start with introductions. Manfredi, let's start with you. Just a brief kind of introduction for everybody who's joining us.
Thank you for inviting me. Manfredi, Catella, CEO and founders of COIMA, which has been set up in 1974. Today runs 8 billion of assets under management across asset class. Super, thanks very much. Mark.
Yeah, thank you, Richard. My name is Mark Holz, Group Head of Research with CORESTATE Capital. CORESTATE Capital is a pan-European integrated investment manager with a strong investment management arm, but also a strong debt finance arm. We have a specific strong interest in residential in Germany, which is classic residential, but also we're targeting the more micro-living space, which is PBSA, which is serviced apartments, which is micro-living in general.
Great, thanks very much, Mark. Hilke.
Hi, thank you for having me today. Really looking forward to the discussion today. I'm Hilke Nijmeijer. I work for CBRE Global Investors, one of the biggest real estate investment companies in the world. We're focusing on all sectors, but I'm specifically focusing on expanding the residential strategy in Europe.
Great, thanks very much, Hilke. Sam.
Morning, everyone. Thank you for inviting me, and good to be here. So I'm Sam Kempe. I'm one of the founders and the Chief Investment Officer of IMMO Capital. We're a little bit different to the other participants here today. We are a tech-driven investment manager using technology across the value chain to aggregate single-family residential into rental portfolios on behalf of institutions. And just very quickly, in case people aren't familiar with single family resi, or SFR as we call it, it's the individual apartments and houses that make up 98% of the housing stock, because approximately only about 2% of the housing stock is actually multifamily. SFR is actually very well established in the US already. Most of the large institutions and pension funds are already very active in this space, owning hundreds of thousands of units. People typically worry that scattered portfolios can't be managed efficiently, but those assumptions have sort of already been proven incorrect in the US with the proper use of systems, technologies and processes. It is possible to manage these portfolios at scale. We're currently in the process of deploying about 900 million for a US pension fund that has now allocated to European SFR, and we've got about another 500 million of capital in the pipeline as well.
Great, really interesting. And also this was something I wasn't aware of, Sam, so interesting for you to join us today and share some of your insights, and we'll drill down a little bit more into that as well. And last but very much not least, great to see you again, Xavier.
Hey Richard, good morning everyone. Xavier here. I'm the Managing Director for Catella as a European resi business. We specialize in investing across the European continent. We were the first one to set up such a fund in 2007, and very much built up on, continue to build up on this idea.
Great, super. Thanks very much. And for everybody who's watching in the RealX auditorium, on your right-hand side, as you look at your screen, you'll be able to see that there's a comment section and there's also a Q&A. I'll be monitoring those and just making sure that we pick up on your questions. One of the joys of this being live is that we can actually answer your questions and pick up on some of your comments and the things that you're particularly keen to talk about. So do ask questions, do make comments, and I'll make sure that we bring these into the discussion. Let's just pick up. Let's start with you, Mark, if we can. just in terms of the outlook, I guess you're coming from the research side there at CORESTATE. I mean, residential's outperformed during the pandemic, gaining market share. I think it's almost a quarter of the total real estate investment. I suppose, what are you seeing as some of the key drivers for the residential sector at the moment, more broadly?
Yeah, sure. Maybe let's have a quick look back first. As you say, about a quarter of the investment volume was happened in the residential space during the pandemic. And interesting, if you look back further between 2016 and 2019, it was more like 15%. So clearly, residential is on pretty much every investor's radar at the moment. And probably more interesting, if you look at the numbers for the first quarter this year, this number has even gone up further. So it was like 23% in 2020, and now it's 28%. And that is the highest share that residential has ever seen. And compared to the global investment market that we've seen, the European market, I mean, which went down by 28% over the year in the first quarter, residential was actually up by 46%. So it's quite contrary in terms of trends. And this is telling you a story. And I think the main reasons why this is the case is, well, investors are looking for security. And it is a highly income secure property sector. It's highly diverse in terms of the rental structure. And now looking into the future a little bit, it is obviously less cloudy than some of the other larger sectors that we have. I mean, what is the future of the office? What is the future of retail? And what is the future of logistics? It is difficult to say. They all have a future, I'm pretty sure about that, but it's a little tougher to tell than what's going on in the residential space. Residential is changing just very slowly. It is changing as well, but it is changing relatively slowly. And that is, I think, what investors are looking for in these highly disruptive times that we are in, looking for security and planning security over the next 10, 15, 20 years.
Yeah, that's really interesting. And Xavier, just coming to you, I mean, there's a lot of positive trends there highlighted by Mark. So do you see these positive trends continuing? And I suppose, how do you see the outlook?
Well, you know, generally, I agree with what Mark has been saying. We still have some pretty, you know, positive winds going in our direction. It's basically because residential is such a basic human need. So whatever catastrophic scenario you might have for the future, you know, resi will always be kind of a safe haven. So I'm not always kind of convinced that it's such a good kind of thing to say that resi will do well in the future, because even though it's true, it also reflects a higher level of uncertainty. Having said this, I also think that we need to consider a couple of things that are really around the corner. Things like the climate change and what that really costs. For instance, you know, I see in our team, but also I think elsewhere, we all focus on, you know, getting some kind of a rating for your asset, being in a BREEAM or some other certificate, right? But the key question is not about the certificate. The key question is, you know, how much will it cost, you know, to get your building down to zero carbon, you know, by 2050? And do we have any means of really kind of planning that, assessing, you know, if we can fund that or how we can fund that? And, you know, so I think a lot of thinking needs still to be done there. And that is also a risk if you don't do that properly. You know? And then things like, you know, what happens if the water doesn't rise like half a meter or a meter, as the suggestions kind of seem to tell us now, but if it's 80 meters, which is the worst case, you know, sea level rising, or take half of half, or take 20. You know? So these type of kind of tail risk events, you do need to think about them and model them. So it's too easy to think that resi will always do well. I think it was difficult to kind of do badly over the last kind of 10 years. But think that you will always do well is I think too easy. And of course, we should do better than non-professional investors. No? So we still have quite a few challenges to think about.
Yeah, and Hilke, let's pick up that with you, because obviously at CBRE Global Investors there, you're looking after the sort of residential impact fund. So let's just pick up on that. How important is that in terms of the challenges and I suppose the opportunities looking at these markets?
Yeah, so the last 2 years we have spent a lot of time diving into the European residential market together with our research team and together with all our local teams in the countries to really find out what the key elements are of the market. So we saw a lot of differences between the different cities, different countries. For example, the percentage of rental share in the total market, which differs between, let's say, 50% in Germany down to 24% in Spain. Also, we see a lot of differences in tenant regime. So countries where the tenant is really protected. If you rent a house in the Netherlands or Germany or Sweden, you have really security of lease. While if you rent in the UK or in Finland, you can basically be kicked out after 1 year or get a heavy rental increase. And the local regulation as well, most of us are aware, is really, really different, leading to a lot of different returns and low correlations between the different cities across Europe, which gives an opportunity to actually have a diversification within the residential market in Europe. But coming back to your question, the main common factor, and that's where we can make an impact, is that all cities across the globe and in Europe face a social challenge of unaffordability and social divide as a consequence of a big demand-supply imbalance. So everywhere demand is way outpacing supply. If you look at UN predictions, the world population will grow by almost 30% to 9.8 billion in 2050. The number of households will even increase more rapidly, and more people will live in the cities. So it's not a short-term challenge, it's a long-term challenge. And that's where we as an institutional investor, together with other institutional investors with a long-term focus, can really make a difference by creating inclusive cities and communities in line with the SDG 11. So we will really focus on adding affordable and good quality, sustainable homes for middle-income households who are pushed out of the cities in the major 15 European cities. And the focus will not only be on adding those homes, but also keeping them affordable in the longer run, and also acting as a reliable landlord as a core principle.
Yeah, I think that's really interesting, Hilke. And maybe Manfredi, just picking up with you, because obviously there you're developing quite a lot of city centre projects, I guess, major projects, transformational projects. So I guess, have you had to integrate a number of these aspects like ESG, but also affordability into these schemes? And has any of that changed because of the pandemic?
Well, starting from the residential, Italy is a little bit the absent player in the institutional market for residential asset class. And this is just about changing. So the shift is going to be considerable for a number of reasons, including the one that Hilke was mentioning in terms of demand for affordable housing, which in Italy as well, obviously, has grown following also the pandemic, which has just accelerated the need. Now, just to give you a few figures, now if you take Italy, we have 12 affordable units every 1,000 inhabitants. The same figure in Germany is 22, in UK is 60, in France is 63, and the EU average is 48. So that's pretty clear gap that we have in Italy. If you move to, for example, student housing, beds for student housing on non-resident students is 8% in Italy versus 20% in European Union. So we do have a quite significant opportunity down here to start an institutional market of qualified, competent landlord, and in the region, and it's going to be a lot in developed to core, because the truth is that the product does not exist in the way the demand is now moving also for ESG matters, but also in terms of layout and most importantly, professional management. So it's quite exciting time, and we do have a quite significant pipeline, and we are just about starting a PRS program for the country.
Okay, great. Thanks, Manfredi. There's a question that's come in from Douglas Edwards. Good to see you joining us, Douglas. Thanks very much for that. Which is, we'd like to hear what the panel thinks about the impact of PropTech in the sector. And Douglas particularly highlights SmartRent, the recent IPO entity in the US. But I'm guessing, Sam, that obviously this technology side is something that you're tracking and is influential in terms of your business. So I suppose, do you want to pick up that point first of all on technology and how that's influencing the sector? Yeah,
absolutely. So, well, the US is much further ahead than us when it comes to the PropTech space. Same with the resi space. You know, multifamily started in the US and then eventually came to Europe. Very much same with the PropTech space. If you look at PropTechs in the US, it's very exciting what's happening in the US. You spend a bit of time and you see so many PropTechs. You're like, oh, I wish there was someone doing that in Europe already. And unfortunately, it's not just easy for them to hop across the pond and you know, apply their technology over here. That it requires a huge amount of product development for them to be able to expand to Europe. But unfortunately, in Europe, we are still very much at the beginning of the curve. I think fortunately, a lot of the PropTech that has started is very focused on the residential space, but it's probably a bit more focused at the estate agency, the brokerage, the consumer brokerage end of the market. PropTech hasn't yet fully made the transition to become more sophisticated. It's happening, and there's a lot of very exciting companies out there. You know, and I would really encourage people to be investigating these new PropTechs that are coming through, because they really, you know, the PropTech, the more sophisticated end of the PropTech space will only be able to mature as fast as institutions are willing to partner with them and test them and, you know, and facilitate their growth. They can't just develop in sort of an ecosystem on their own. They very much need to partner with institutions and bigger professional investors to then be able to develop the products that can serve the broader institutional market. So it's coming. It's it is very exciting what's happening out there. Great, thanks, Sam. A couple of questions have come in as well, and we'll just deal with these if we can. Thanks very much, Marcus Seelebeck, for your question. And Marcus's is on regulatory uncertainty, and how do we deal with that? I guess as a challenge, particularly for the industry. I don't know whether anybody wants to pick that up in terms of the sector, and I don't know whether Marcus is thinking more about the sort of rent elements that there are in Berlin, for example, and elsewhere. But does anybody want to pick that topic up in terms of the regulatory frameworks?
Yeah.
No, Hilke, go ahead. Sorry, go ahead.
Yeah, well, I already mentioned the regulation is very locally and sometimes hard to predict. I think most municipalities and governments are acting a bit in the short term to solve the affordability issue, where we all know that if we really solve the affordability issue, we have to build more and make sure there's more homes available, so there's a better balance in demand and supply. But also already mentioned, this will be a challenge in the long run till 2050. So we have to deal with local municipalities and governments actually increasing regulation. I would say you can anticipate that partly. If you already anticipate that in your underwriting, then still you can get to nice returns, at least predictable returns and stable returns. The challenge is more where it's unpredictable and you cannot foresee something, and yeah, that's really hard to manage. So that's the way we deal with it. We try to be a bit defensive, anticipating regulation which we see changing in the course of time.
Okay, good. And Xavier, did you want to pick up on that as well?
Yeah, you know, I start to rethink the topic a little bit, because, you know, ultimately, you know, this question of non-affordability is with us since decades. You know, so we live in a system that cannot solve that issue. It simply becomes more political now. And it has more to do with things like globalization, that we put jobs elsewhere, and technology, you know, we substitute jobs, you know, and also lack in faith of our basic democratic institutions, including all kinds of populism. So I think those are the three real drivers that actually make it a little bit more of a political, or definitely more of a political debate. But my point is, we've not been able to solve this issue like for decades. So I think perhaps we should kind of rethink the system of how the market works, and see if we can get out of this tunnel vision. So the public sector has a tunnel vision, institutional investors have a tunnel vision, social housing sectors have a tunnel vision, tenant associations have a tunnel vision, and we all think about solutions within our tunnel vision. And I think those solutions produce the problems that we have, so they are not good solutions. So perhaps we should experiment, and an organization, I think, like ULI could help us with these things, experiment in certain places to kind of reshift the angle on all of this, and see if we all together with the stakeholders can move the needle by changing the system, rather than finding a little bit of a French called bric-a-brac solution. I still think that will not really work.
Okay, and if anybody from ULI is watching in, I'm sure they will get that message, Xavier, as well. Maybe let's pick that up a little bit with you, Mark, first, and then I'm interested in your view, Manfredi, on that as well. So, Mark, obviously, CORESTATE involved in developing city quarters, but also, you know, in that sort of mid-market element of affordability with the sort of co-living, micro-living kind of aspects of it. I suppose, how have you experienced that in terms of working with both I suppose the local and national government where you've had to? How important is that collaboration, and is there enough of it, as highlighted by Xavier there?
Well, I guess there's not one answer to that. That very much depends on where you are, which project you are working with, and which stage of the project you're getting into. I think the collaboration, as you mentioned, city quarters, that is something that is typically in line with what the city wants. Mixed use, dense, reusing of brownfield sites, for example, with different sorts of usage, also in terms of the residential, getting some affordable housing in there. So there, the collaboration, even though it's complex projects because they're big, there the collaboration tends to work quite well because everybody basically wants the same thing. But there can be other projects, of course, where it is more difficult. And maybe coming back to a point that Hilke made about how different regulations are across European countries. If you drill that down to the affordable housing issue, it's even more complex. It's adding 2 or 3 layers on top of that, because it's not really regulated on a country by country level, but it's regulated by federal, state, or even by city levels. So it's incredibly difficult to get, you know, one consistent strategy in terms of affordable housing for pan-European strategy. So it's very, very complex issue to deal with.
And Manfredi, obviously that's something that you've been having to look at, particularly there in Italy. I suppose, what's your experience also of I guess the length of time it takes to bring these projects to fruition, and also the kind of collaborative side with both local and national government?
Well, I think that as far as Italy, the big elephant is that our cities are very old, in many cases antique, and the bottom line is that we now have to regenerate massively our country. And regeneration, as we all know, is a complicated activity, which by definition require strong collaboration with the public authorities. But I think each of us is experiencing in our organization a major evolution in terms of investing in people and expertise, from obviously PropTech to ESG and so on. And the public sector should do the same. So, and it's much slower, the pace where the public sector catch up in upskilling the organization. So I think it's a very interesting timing in terms of evolution, but will require time. Milan, for example, is a city that has had a good vision from the public perspective, and in terms of regulations and in terms of urban planning department, the city is performing quite well. So ultimately, the time to regenerate it's comparable to other European cities. So I would say Milan is in good shape, but the rest of Italy will have to catch up. The good things, just to conclude, is that for the first time in the recent history, we have Europe that is united and has expressed a common vision, with very clear guidelines. Obviously, I'm referring to Next Generation EU. And each country will have to adapt, and each government will have to push now through the National Plan of Recovery and Resiliency. This will be a very important accelerator. And in Italy, I think that will have an impact particularly strong, given the gap, given the wider gap that the country has on a European basis relative to other European countries.
Great, thanks, Manfredi. I'm going to pick up a couple of questions that have come in, and thanks for yours, Michelle. I'm going to come to yours in a second and pick up some of those capital points. But another question coming in, particularly, thank you, Douglas, for this one. Could we hear more in terms of SFR and how the aggregation of investment is managed from a management basis, both at the real estate level as well as information? So some quite specific ones there, which I guess, Sam, are for you to pick up on.
Yeah, that's fine. So just to so the way we've built our platform, so the technology is running across the whole value chain, and that's a really important part. And a key part of that is it's essentially automating workflows. Automating workflows is not super sophisticated tech. It's very complex because, as everyone knows, like Resi has so many different scenarios, so many different permutations. So it takes a lot of time and effort to map all of these workflows and then automate them. But when you have mapped them all and you've then digitized them all, the data can then be flowing across the whole value chain, which is really key. It can't be this part. I mean, it can, but this is one of the troubles that big corporates are having, where they're trying to retrofit sort of technology, is doing a bit of technology here and then a bit of technology here, another bit here. They're not all connecting and it's not all flowing together, and the interfaces just aren't really working. So that's one of the struggles a lot of corporates are having, sort of bringing technology in. In terms of the management piece, I can give you some examples. For example, like when we do our renovations, we've completely standardized the way we plan our renovations and the way we conduct our tender processes, and then even the way we manage the contractors to do the renovations. We've developed what you can essentially imagine as sort of digital forms, where they are having to submit information to us on a regular basis, which includes photos and everything, so that our team back in the office, a centralized team, can be quality controlling a lot of what they're doing, and not having to go to, not having to be running between all these different sites every single day to sort of check up what's happening. They're only having to visit sites when issues are being escalated or for the handover at the very end. When it comes to the lease up, we've fully digitized that process because, as I mentioned, all the data is flowing seamlessly through the value chain. We can automatically create listings which automatically get pushed to the listing websites. All of the inquiries are coming through to us, and we're even doing most of our viewings, not just during COVID, but actually pre-COVID. We're doing a lot of our viewings virtually as well, with whether it's Matterport 360s or some WhatsApp tours where the existing tenants are happy to sort of do some tours for tenants. The leases are all digitized, DocuSign. Even the check-in process is being done by the tenants themselves. Property management as well. Imagine we work with PropTechs. Actually, we don't do this one ourselves. We work with PropTechs, which are essentially, imagine they're like an Uber for maintenance people, where our tenants report issues to us online, and then we are automatically farming out the tickets to these sort of Uber maintenance people, and I think our response times are less than 30 minutes. So you can see there's so many different elements of technology that's being brought into play on the management piece there.
Yeah, very good. And I hope that answers your question, Douglas, but if not, drop another note in the chat and we will pick up further on it. Xavier, I just wanted to pick up with you a little bit in terms of the capital. What are you seeing? Are you seeing a greater interest, more flow of capital coming into the sector?
Yes, I think that will hold true for all of us in the call, right? I think resi is seen as a safe investment niche, and given the lack of safe investment products, if you buy a Dutch bond, you're guaranteed to get less money than you put in, right? So it's hard to make a case for buying Dutch bonds, but a Dutch bond was obviously a safe asset for a long time. So we have gotten so far along the debt cycle that some of our normal kind of ways of looking at the world need to be reevaluated. And resi stands out because it's such a fundamental human need with a very stable cash flows and all the reasons that we mentioned earlier on. So I think investors really picked up a lot on that, and may at the same time also be underestimating a little bit of the real risks that are in this asset classes. Now we kind of highlighted a couple of them, but I guess that goes with the popularity. Also the fact that it just popped up to me in my head just in the previous kind of person talk. Don't forget, we're not allowed to have a crisis anymore. It's just strange, no? Because that is a problem for affordability. And normally, affordability is kind of put straight if house prices drop 35%, which is what we generally do in a crisis. No? We have a huge crisis and house prices, they stack up. It's completely counterintuitive. Of course, we all understand what's happening, right? But it takes away a little bit of this, and it puts the finger a little bit on this issue that I want to point out, that the baseline value of everything looks good. But if you think about it and look at some of the fundamentals, you must realize that surely, there are bigger risks. And unfortunately, affordability is not helped by the fact that we're not having a crisis. A crisis is always a way to redistribute wealth. And we're not having that. The haves are getting more and the have-nots are getting less. It's also a thing to consider.
Yeah, feel free anybody to pick up on that point as well. I just wanted to pick up this question from Michelle Doran. Thanks, Michelle, for this, which is, given where yields or pricing is today, picking up on that point, how do investors access the market if they don't have very low cost of capital? What's the spread between development yields on cost versus standing yields? So I don't know if anybody wants to pick that up, and any other broader views on the capital side.
Well, I can certainly talk about yields and pricing here. coming from the German angle, the premium that you get on developments is actually not that big anymore. So if you're going into the core multifamily standing asset in a good A or B city, you're probably in the realm of 3% initial yields. And if you target in like a forward funding, forward commitment development kind of thing, it's 3.3, maybe 3.5, depends on where you are, what the supply demand relatives are. So relatively close together, 10% roughly that you get. And I think that is different in different countries. So the higher your risk, the higher your risk premium on developments is going to be. But that very much, depends on the individual asset that you're targeting. And well, yes, if your cost of finance is higher, is going up, it will become difficult at some point to justify these kind of yields.
Maybe if I can add something on that in the European basis, I don't see it really differently from Germany, although Germany and France are the most challenging from an acquisition perspective in terms of yields. But the spread between yields is the gap is closing. So the more risky Central European countries, but also Italy, for example, they're catching up with the rest of Europe. So the gap is closing, especially in the maturing markets. You see a rapidly decline in yields, so increase of prices. And the same counts for the spread between development yields and standing yields. That gap is, in some countries, it isn't there at all anymore. For example, in the Netherlands, you see that gap being really small. And in the more developing countries, that gap is also getting smaller and smaller. So that's really in line with what Mark is telling for Germany.
No, great. Thanks very much, Hilke. I wanted to pick up a little bit in terms of, I suppose, some of the topics around ESG, carbon reduction. And Xavier, I know your Elithis residential towers are focusing on being carbon positive. Is that an element that's being driven by the capital, by the occupiers, by yourselves as investors, and how important do you see that trend?
Well, first of all, I think we have to acknowledge the fantastic expertise of Elithis, because they were the fountainhead of these towers, and these towers are kind of incredible because they produce more energy than the tower and all the tenants kind of consume on a yearly basis, at prevailing market costs. Also, in the past, everyone could kind of suggest that you could make energy positive towers, but the price increases were 20–30%. Here we're at the same price level. So something is going on that's interesting. And the tower is there since 2018. Facades are not falling down. Technology is not falling down. Tenants are not leaving the building. The waiting lists. Last week the French TV was there again. So the thing is working, right? So, and I think the relevance also of that tower for the debate that we're having, and the point that we need to share is that if you reduce energy costs kind of to zero, in the case of France, where the first tower is, you increase purchasing power of the household by 1,400 euros net. For a household that kind of has 30,000 euros on average, that is material. So you kind of have a sword here that has two very interesting sides to it. First of all, we try to do something against climate change. Now, we will not solve it, but we can take the responsibility to do our little part in it. And I'm sure that many will follow and develop further on these ideas. But that's a very important thing, because we do think that climate risk is a very considerable risk, also for housing markets and also in big cities. So we need to do something about it. We need to think about it and put money there, to experiment and to make kind of solutions work. So that's what we do. But at the same time, we're also tackling the affordability topic, because you increase purchasing power, and that at a level which is at cost to the market. So So yeah, we're kind of really interested about what we can develop with the facilities. Our part to it, by the way, is different because I think the fountainhead asset is EDTs. We kind of will obviously do all the classical things of investment management and funding, but we're also redefining risk return because it is an impact kind of vehicle. How much purchasing power do you give back to the tenants? How much do you give to the institutional investor? There's a debate there. So your return element will be an element of shared return. Your risk element will be different because these type of assets have different risk levels. There is no regulatory risk, for instance, because it's an asset that's in 250 in terms of regulation. So we're redefining that. And of course, we're co-doing with EDTs the business development because we need to work with the technology in the building. And perhaps one answer to your question as to what makes kind of this building possible. There's no one single bullet, a kind of couple of key points. But one interesting thing is a nudging app. It's called Aladdin, like the ghost that comes out of the bottle, and it nudges the tenants. And that is a technology tool that will obviously be expanding to learn more which technologies work in terms of nudging. And of course, will include all kinds of leasing, maintenance, technical, and other kind of contractual obligations as well. And with that, by building 100 towers, you can kind of make those towers better again every time that you develop them. So this is also a little bit of an example of thinking not one plot or one tower or one development project, which is fine and nice, but think about something that we can scale up and kind of redefine also the roles and responsibilities of every kind of party in this development. And that's what we're kind of engaged in doing.
Okay, good, Xavier. And Manfredi, just coming to you, because obviously in the Porta Romana project, you're building the accommodation for the Olympics. And then that's going to have a second life, in terms of affordability, student housing, those kinds of things. How important is that sort of planning and the ability to be able to change use and flexibility?
Well, in this case, just for everyone to go to what project is, this is a railway yard dismissed, now very close to the city center, named Porta Romana. It's a kilometer by 300 meters site. And what is the peculiarities of this site is that we'll host the Olympic Village for 2026, which is the Winter Olympics that will be taken will be hosted in Milan and Cortina. So the very interesting challenge that we have is that the Olympic Village, as you were pointing out, will have to be designed in a way that already accommodate the following use. So there is the event phase and the legacy phase. So the event phase is clearly the Winter Games, but it will last for a few weeks. And then there is a permanent use that will be affordable housing and student housing. So the big challenge that we put as is fundamentally to have net zero carbon and net zero retrofit for this product, which it's a new challenge comparing to the way we have developed up to now, because you normally know what is the final use and you build for that use, not for an event use and then a permanent use. So this is a very interesting exercise for all of us and a challenge that we are basically welcoming as a bit the frontier of our development.
No, great, thanks, Manfredi.
I add to that, Richard. Sorry, I was going to say,
go ahead, Sam,
the retrofitting point is really important, and I think that's becoming even more increasingly important, not just within the resi space, but across commercial real estate. More and more people are talking about it's not just building new. Obviously, very much has a place. We need to be solving the demand supply imbalances, as Hilke was mentioning earlier on, right? But there's also a lot of stock out there that needs to be recycled, it needs to be upcycled, it needs to be brought up to standard. A lot of residential out there is just not fit for purpose. And I'm not talking about creating something that's super high end, but even just a lot of affordable housing, or a lot of housing that's out there for housing associations, it's shocking, the quality of it. It's atrocious. It's embarrassing how poor it is. So I think, yeah, the recycling element is really important, and that's also something that's quite important to the institutions we work with on the single family resi side, is that you have existing stock that can be recycled. It can be brought up to standard, and it's already there. It doesn't have to be built from new. I think in the UK, for example, and this is across all real estate, about 10% of the UK's carbon emissions comes from construction, which is a huge number. And a lot of investors are therefore looking, how they can recycle existing stock. And single family homes, there's millions and millions of units out there already that are below standard and ready for recycling, and they're in good locations already. They're in downtown locations or within commuter hubs. You're not having to go, really far out to find cheap land where you can now just analysis work. There's so many build to rent operators out. They're struggling to make their numbers even stack up for non-affordable housing. So for affordable housing, I think the challenge is probably even greater to make the numbers work. So often, affordable housing ends up being creating a block of flats in a poor location where the land was cheap enough. It's the costs of being value engineered to an inch to make the returns work, which often ends up resulting in an inferior housing product. And then you suddenly put all the affordable tenants into that block. Why can't affordable tenants be living in existing communities? And that's something that we feel really strongly about, is that communities should stay diverse. It's not about doing sort of really lovely gentrification, and obviously there is a place for gentrification, but you should be enabling affordable housing to exist within these gentrified communities, and allow people to remain in their existing communities and keep them diverse, and and not just putting them into affordable accommodation that's on some fringe location in apartments that are getting smaller and smaller, but allow people to stay in good quality homes in existing neighbourhoods, in apartments or houses that are of sizes that actually meet their needs. I think that's something that lots of people don't necessarily really think about. They're so focused on making the numbers work, and I think that definitely is a challenge for the industry. So yeah, I would encourage people to look at single family and think about how a part of their affordable housing strategy is allocated to existing stock or single family stock.
Great, thanks, Sam. And Hilke, I guess, how are you seeing that in terms of, because it seems to me, certainly from the news that we've been picking up and what's happened in these discussions more widely, that there's more of a focus on wellness, well-being, and that would, I guess, pick up that point from Sam, really, that it's not just about the return, but there's also that element in terms of the impact of affordable housing, Hilke.
Yeah, maybe first of all, I couldn't agree more with Sam that we shouldn't only focus on newly built homes. That's part of the solution to get more affordable homes, but really upgrading the standing stock is more or less 90% of the total. So that's where we should focus on as well, to improve affordability, to improve environmental sustainability, and to improve well-being. So it really goes hand in hand, if you ask me. So we can create really affordable homes, but if we rent out only 15 square meters in a very old-fashioned part, a very bad house, so to say, that's not really reaching our goal. So we can really make impact if we combine affordability with lower energy bills, and with a higher quality. So quality in size of apartment, but also the surrounding. Is there a green park in the neighborhood? Are there amenities, local amenities around? And do you get to public transport very easily? And can you get to the city center with public transport, etc.? So it's not really only about the apartment. It's also about the service you deliver. it's about the entire living surface as a product, what we should think about and which we should care about. So focus on well-being, really, really important next to affordability and sustainability.
Okay, great. Thanks, Hilke. Quick question as well here is, should we look from a return perspective at residential as a standalone investment or within a sort of mixed use asset? So I don't know if anybody wants to pick that up just in terms of, you know, is this a standalone, you know, are we best looking at that from an investment point of view as a residential asset or within that sort of mixed use perspective?
That's a very interesting point, Richard, and I totally agree with what Hilke and Samantha was mentioning before in terms of how you have to think in the specific topic residential within the other uses. For example, when we develop, one of the biggest topic in this moment is what we call the public spaces, and public spaces is everything that is outdoor spaces and everything that is a ground floor. And more, as we all know, the uses of the buildings are becoming more hybrid. So how do we turn, for example, the ground floor of a city, which is so important because it makes the city safe and livable and active and all, and the retail is becoming an issue for all the reasons that we know. So how do you activate a community? And because we grew up in our experience at neighborhood scale, that is one of the most fundamental questions that we pose to ourselves. So the bottom line is, let's take, we were speaking about the Olympic Village. Now, the Olympic Village, we do the design competition and we receive a project that were like dormitory, like big buildings, standalone and so on, which doesn't make any sense in our side, from our perspective. So we are integrating the student housing with other type of housing, and most importantly, how do we activate the ground floor? And it start becoming some co-working and it becomes some other activities. So at that point, what asset class is it residential because it's prevailing residential, or is mixed use? So I don't think this, it's a good question for, I think, for every investors to respond, because in general, investors traditionally like to have asset class with their own criteria. So bucket, like silos. Xavier was speaking about tunnel before, and Samantha as well when she was speaking about technology. So at the end of the story, the integration, which is the key word, which is happening everywhere, also in asset class, is a problem for an investor, because you suddenly find yourself, which are you investing in office, residential, and logistic, or not? So when you invest in Porta Romana, where you have last mile, residential, and everything, what asset classes?
Okay, great. And I've just noticed we've got around 8.5 minutes left. Goodness, time has flown. So we'll have to be very efficient. Just a couple of things that have come in. Ron, thanks very much for that. This is from Ron Van Bluis. On behalf of the board of the Senior Housing and Healthcare Association, I'm curious how the experts look at seniors in this asset class or field of real estate. So I don't know, let's pick up that a little more broadly, I suppose, but particularly looking at the sectors within that, because obviously you've got, and there needs to be affordable issues there for sure in terms of senior living as well as student housing. But how do you see those different sort of niche sectors? Does anybody want to pick up on those points?
I can quickly touch upon on the single family side. One of the we haven't yet done it, but it's something that we're discussing with institutions already. Is again not necessarily where you need the assisted living, but where people are still older generations are still quite independent. But you know, in Germany, a big issue is that you have sort of 5-story properties with no lift, and you know, they just can't. It gets to a point where they just can't climb all those stairs, right? It's just not possible. But at the same time, there's older generations, even, you know, their mobility is struggling a little bit, but they don't necessarily want to go into an assisted facility. but they want to stay, and they want to stay in their existing communities. They want to stay where, you know, their friends are, where their family is nearby. So one of the things that we've been talking about with one of our institutional investors is about specifically targeting ground floor properties in existing communities where we could offer those specifically to more senior generations. So that rather than sort of creating a specific facility where, again, it's like you're bundling all the older people into one place, and that isn't, you know, that isn't how you know, older generations necessarily want to be treated. They want to stay near their friends, their family, their local cafes and restaurants where they're comfortable and happy. But there just isn't the supply. There just isn't the stock being offered to them.
Yeah, I think that's interesting. And from your point of view, Hilke, are you looking at those other aspects in terms of senior living and those kinds of, you know, more niche sectors of the asset class in general in terms of affordability?
Yeah, first of all, I'm not really focusing on the niche sectors myself. So we are really focusing on the PRS market, although the company, Global Investors, is focusing on senior living and student housing and co-living concepts as well. What I think is really important, well, two things, is that the more care you need, the more important it is that the operating partner we work with is really specialized and really knows what they are doing. We do not have that in-house, so they're the partners we work with become really essential. And secondly, where Samantha is talking about as well, inclusive cities and communities also mean that we keep the communities inclusive for elderly people as well. So putting them apart in different houses is not maybe the best idea, although the more care you need, the more logical it becomes to do so, since then the operating partner can also operate the single assets where the elderly people are living together.
Great. Thanks, Hilke. So we've got 5 minutes left. So if you've got any questions, now is the time. Don't be shy. Do put them in because there are only 5 minutes left. A super question, which I'm actually going to use as my last question, unless you have any more to come. But this is from Antonio Marimbatala. Thanks, Antonio, for this, which is since March last year, we've seen a flight to quality with investors focusing in Northern Europe, Nordics, as yields compress in these countries, 50 bits in the last 6 months. In your view, what do you think the smart money will go? Where will the smart money go next, and why? So that picks up the investment briefing theme of this in one easy way. Thanks very much, Antonio, for that. So where do we think the smart money will go, and why? You just unmuted there, Mark, so I'll come to you first.
I think even though yields compressed in Northern Europe, in the Nordics, I think there's still opportunities out there. And if I'm taking Germany as an example again, but Netherlands, for example, is another good pick. Those countries are very, very polycentric, and you don't have to be in the top 7, top 2, top 3, or whatever. You can go down the ladder to the tier 2, tier 3, or tier 4 markets, which make a lot of sense, and which also do deliver, you know, higher net initial yields, but also staying with the German examples, did deliver some decent rental growth. So there's actually a good performance and risk-adjusted case for these second and third tier markets within the more secure countries. So I think there's more diversification potential within the markets that are targeted highly already.
I would also add exactly what Mark was saying. It's tier 2 and tier 3 cities are definitely a really great bet, but I think it's also the B locations of the tier 1 cities. So that's the peripheries. The peripheries are starting, you know, the growth is starting to slow in the cores because they're just starting to max out. But the peripheries, we've been seeing the capital growth has been picking up quite considerably. So I think the peripheries and commuter areas of those tier 1s are very interesting as well.
Okay, great. Thanks very much, Sam. Let's come to you, Xavier.
You know, I think I hope that our brains go for pro-Europe vote. I think that the idea of the European project has been weakened over the last decade and a little bit more. And I don't think you can make an investment case in Spain or in Portugal or in Italy without making this presumption that the EU will hold together. Because that's a completely different scenario than where it would kind of scatter out. And our belief is that the EU will stick together, but I mean, I was hugely surprised about this Brexit thing that happened. And we have some on the eastern part of Europe. We have countries that were liberated from a non-rule of law dominance in the early 90s. And kind of start not respecting the rule of law anymore. So these fundamental ideas that all kind of got used to and forgot about, but are so dominant to our worldview and investment analysis, they start to shift a little bit. So I hope that our brains go for a pro-European vote, and as long as that's the case, we will happily be investing also, obviously, in Spain and in Italy and in other countries in Southern Europe, and hopefully more in Central Europe as well. But it's
okay, good. Great, thanks very much, Xavier. Manfredi.
Well, smart money will fly to Italy, obviously. I'm joking. I mean, I think that this is an amazing. We all have a great opportunity to live in this historical period, and also after having had this tragedy experience of COVID. So I think smart money will understand the discontinuity and the acceleration, and will look the right horizon to generate the value. So to me, it's more about understanding the fundamentals and taking the right time to create value.
Great, thanks very much, Manfredi. And last to you, Hilke. I'm sure that the smart money will rush into your fund, but in terms of the smart money, where do you see, I guess, the investment opportunities, Hilke?
Yeah, I would say most important is not to think from a supply perspective, but really follow the tenant demands and try to understand as good as possible where the future demand will be, and that's where we should be with our money as well.
Great. Thanks very much, Hilke. Thank you to all the speakers. Thank you for joining us and for all of your questions, which has been great. Really interesting discussion. The next session we've got is actually tomorrow morning at the same time, in the same place, and we'll be focusing on European opportunities there, and particularly taking a look at resilient retail. So looking at food retail, experiential retail, local retail, looking at those aspects, but particularly looking at because retail is obviously a very broad landscape, but certain aspects of it have been outperforming during the last 12 months, and that's what we're going to focus on, the overall outlook, but particularly look at those resilient retail aspects. Thanks very much to all of the speakers for joining us today. Thank you as well for joining us at RealX, and look forward to seeing you at the next one. Thanks very much, everybody.
Thank you.
Thank you.
Thank you. Bye-bye.
Thank you.